Every time, the same pattern. Every time, everyone sees it coming. Every time, nobody stops. And every time, millions pay the price. So here's the question: what are we doing right now that future documentaries will call the obvious mistake? Because I can tell you exactly what it is. And you already know the answer. Britain just fought expensive wars. The government was drowning in debt. They needed a solution fast. So they created the South Sea Company and gave it a monopoly on trade with South America. Sounds promising, right? There was just one problem. Britain had no trade with South America. Spain controlled all of it. The South Sea Company had no business. No ships making voyages. No goods being traded. Nothing. But the directors didn't care. They had a better plan. Make people believe it was real. They bribed members of parliament. They spread rumors about imaginary profits. They paid dividends with money from new investors. Classic pyramid scheme, 1720 style. And it worked. The stock price exploded. People mortgaged their homes to buy shares. Servants bought shares. Nobles bought shares. Even the king bought shares. Sir Isaac Newton watched from the sidelines. The men who discovered gravity. Who invented calculus. Who calculated the motion of planets. He bought early and sold for 100% profit. Smart move. Then he watched the price keep climbing. And climbing. And he couldn't stand it anymore. He bought back in. At the peak. August 1720, the bubble burst. The stock price collapsed. Thousands were ruined overnight. Families lost everything. Suicides followed. Newton lost £20,000. In today's money, about 3 million. His response became legendary: I can calculate the motion of heavenly bodies, but not the madness of people. Here's what nobody tells you about that quote. Newton wasn't describing other people's madness. He was describing his own. He knew it was a bubble. He sold at the right time. Then his greed pulled him back in. The smartest man in the world couldn't resist. And 200 years later, America made the exact same mistake. October 1929. A man walks up to his bank. The doors are locked. A sign says, temporarily closed. His life savings are inside. He'll never see that money again. Neither will 9 million other Americans. The 1920s were boom times. The stock market kept rising. Banks took depositor money and invested it in stocks. No insurance. No safety net. Just trust. When the market crashed in October 1929, banks lost everything. Depositors panicked. Bank runs began. People lined up for blocks trying to withdraw their money before it ran out. Then the Federal Reserve made a decision that turned a crisis into a catastrophe. They raised interest rates. In the middle of a collapsing economy, they made borrowing more expensive. They were trying to protect the value of the dollar. Instead, they choked off what little economic activity remained. Over the next 3 years, 9,000 banks failed. $7 billion in deposits vanished. 25% unemployment. The Great Depression had begun. The mistake wasn't the stock market crash. The mistake was what happened next. A choice. Made by people who thought they were doing the right thing. Just like what happened in the 1980s, when politicians decided regulations were optional. Charles Keating built a yacht. Then another. Then another. He paid for them with your grandmother's retirement savings. And 5 U.S. senators helped him do it. 1980s, Reagan deregulation. Savings and loan institutions were suddenly allowed to make risky investments. But here's the catch: deposits were federally insured. Which meant if they lost money, taxpayers covered it. Charles Keating ran Lincoln Savings and Loan. He took depositor money and invested in junk bonds. Risky, high-yield garbage. When regulators started asking questions, Keating didn't panic. He paid off 5 senators. $1.3 million in campaign contributions. These senators pressured regulators to back off. The Keating 5 scandal. They said Keating was being treated unfairly. In 1989, Lincoln S&L collapsed. 23,000 customers lost $285 million. Total crisis, over 1,000 savings and loans failed. 1,430 failed institutions. The taxpayer bailout. $160 billion. Charles Keating spent 4.5 years in prison. The 5 senators. Mild rebukes. Their careers continued. The pattern was becoming clear. Money beats accountability. Politics beats justice. And when the next crisis came, the rules would be even weaker. But this time, the people running the show had Nobel Prizes on their walls. 2 Nobel Prize-winning economists walked into a hedge fund. This isn't a joke. Myron Scholes and Robert Merton won the Nobel Prize in Economics in 1997. They were celebrated as the smartest people in finance. They had a theory: mathematics could eliminate risk itself. Their fund was called Long-Term Capital Management, LTCM. They started with $4.8 billion. Then they leveraged it, borrowed against it, multiplied it, until $4.8 billion controlled $1.25 trillion in positions. For every $1 they owned, they controlled 25. For 4 years, it worked perfectly. Returns of 40% annually. Wall Street called them geniuses. Banks lined up to lend them money. Then August 1998. Russia defaulted on its government debt. LTCM's mathematical models said this was nearly impossible. Their equations assumed markets behaved rationally. They assumed panic couldn't spread globally in days. They were wrong. In 4 months, LTCM lost $4.6 billion. Everything. Gone. But here's the terrifying part. Their positions were so enormous that if LTCM went bankrupt, it would have triggered a global financial collapse. Banks worldwide would have fallen like dominoes. The Federal Reserve organized an emergency bailout. 14 banks. $3.6 billion. The genius mathematicians nearly destroyed the world economy. Because their models forgot one thing. People don't behave like equations. Enron's employees had retirement accounts. Standard 401k plans. The kind every working American relies on. There was just one rule. Their retirement savings had to stay invested in Enron stock. The executives could sell whenever they wanted. Guess what happened next? Through the 1990s, Enron became America's darling. Named Most Innovative Company by Fortune magazine 6 years in a row. Stock price soaring. Executives celebrating. Employees watching their retirement accounts grow. Behind the scenes, CFO Andrew Fastow was building a maze. Fake companies. Off-book partnerships. Shell corporations designed to hide one thing: $27 billion in debt. Debt that would have made Enron worthless overnight if anyone found out. Their auditor was Arthur Andersen, one of the most respected accounting firms in the world. They reviewed the books every year. They saw everything. They approved it anyway. Why? Because Enron paid them $52 million a year. October 2001. The SEC announced an investigation. Within weeks, the maze collapsed. Executives sold their stock immediately. Employees couldn't. The stock fell from $90 to 26 cents. 20,000 jobs vanished. Employee retirement accounts, some worth over $1 million for long-time workers, became worthless paper. Nobody warned them. Because the people who knew were too busy selling. Arthur Andersen dissolved. 85,000 jobs gone worldwide. Ken Lay, Enron's CEO, died before sentencing. And the entire financial system watched. And learned nothing. 2007, a Wall Street trader sends an internal email. We just sold this crap to widows and orphans. He's talking about mortgages. Millions of them. Given to people who couldn't afford them. Bundled together into packages. Stamped with AAA safety ratings. Then sold to pension funds, retirement accounts, city governments, and anyone else who trusted the system. He knew they were worthless. His boss knew. The rating agencies knew. Another internal email from a rating agency analyst: we rate every deal. It could be structured by cows and we would rate it. Another: let's hope we are all wealthy and retired by the time this house of cards falters. They hoped to be gone before it collapsed. They weren't. 2006, housing prices peaked and started falling. Borrowers who couldn't afford their mortgages in the first place started defaulting. The packages built on those mortgages started unraveling. 2007, Bear Stearns hedge funds collapsed. 2008, Lehman Brothers filed for bankruptcy. The largest bankruptcy in American history. 158 years of business. Gone in a weekend. AIG required $182 billion in taxpayer bailouts just to survive. The final toll. $10 trillion in wealth destroyed. 10 million families lost their homes. 8.7 million jobs disappeared. The worst economic crisis since the Great Depression. The rating agencies that stamped fraud as safety. They paid fines. Kept operating. The traders who sold crap to widows and orphans. They kept their bonuses. Not a single major Wall Street executive went to prison. And somewhere across the ocean, a small country was about to reveal that even governments played the same game. While Wall Street was collapsing in 2008, Greece was hiding something. For years, they'd been lying about their deficit numbers. Goldman Sachs helped them disguise debt as currency swaps. The books looked fine. The reality was catastrophic. When the truth came out in 2009, Greece owed 300 billion euros, more than their entire economy. The European Union faced a choice: bail them out or let them collapse and risk a domino effect across Europe. They chose bailout. But with brutal conditions. Greece had to implement austerity. They slashed pensions by 40%. Cut healthcare spending. Fired public workers. Raised taxes on everyone who remained. Unemployment hit 27%. Youth unemployment reached 60%. Suicides increased by 35% in 3 years. Meanwhile, the debt barely decreased. Why? Because austerity during a recession is like bleeding a patient to cure anemia. It makes the problem worse. Tax revenues collapsed faster than spending cuts. The economy shrank by 25%, worse than America during the Great Depression. And here's the part nobody talks about. The bailout wasn't for Greece. It was for German and French banks who'd lent to Greece. The money went straight through Greece to pay those banks. Greek citizens got the bill. Foreign banks got paid. Sound familiar? March 8, 2023. Silicon Valley Bank is the 16th largest bank in America. $212 billion in assets. Trusted partner to half of all U.S. startups. March 10, 2023. Silicon Valley Bank doesn't exist anymore. What happened in 48 hours? It started with something boring: interest rates. For years, rates were near zero. SVB took customer deposits and invested them in long-term government bonds paying 1.5%. Safe, stable, boring. Then the Federal Reserve raised rates to fight inflation. Suddenly new bonds paid 4 to 5%. SVB's old bonds, paying 1.5%, lost massive value. On paper, they were down $17 billion. Not a problem, unless you need to sell them. On March 8, SVB announced they'd sold $21 billion in securities at a $1.8 billion loss. They tried to raise capital to cover it. The announcement spooked investors. Venture capitalists told their portfolio companies, "Get your money out now." This is where technology changed everything. In 1930, a bank run meant lines around the block. It took days. Banks could close doors, restrict withdrawals, buy time. In 2023, a bank run is just clicking buttons. $42 billion withdrew in one day. All digital. All instant. By morning, SVB was insolvent. By afternoon, regulators seized it. The second and third largest bank failures in U.S. history happened that same week. Signature Bank. First Republic. All for the same reason. And here's what should terrify you. There are hundreds of regional banks holding the same underwater bonds right now. So now we arrive at today. And the question from the beginning, what obvious mistake are we making right now? Let me show you the pattern. Companies with no revenue valued at billions. Check. AI startups raising hundreds of millions with no product. Assets with no intrinsic value treated as investments. Check. NFTs sold for millions. Cryptocurrencies with no use case valued higher than major corporations. Leverage on top of leverage. Check. Crypto exchanges offering 100x leverage. AI companies burning billions in venture capital to subsidize growth. Everyone knows it's unsustainable. Check. Every honest investor admits valuations make no sense. Every economist warns about bubble dynamics. But nobody stops. Check. Why? Same reason as always. Because right now, it's still working. The South Sea Company stock kept rising until it didn't. Banks kept gambling until they couldn't. Dot-coms kept fundraising until they couldn't. Housing prices kept climbing until they didn't. The pattern is always the same. Something new and genuinely revolutionary appears. The internet was revolutionary. Housing markets expanding was good. AI will change everything, that part's real. But then comes the mistake. We assume the revolution means this time is different. We assume normal rules don't apply. We assume price doesn't need to match value. And we're doing it right now. AI will transform the world. Blockchain has genuine use cases. These technologies are real. But that doesn't mean every company using these words deserves a billion-dollar valuation. It didn't mean every website deserved millions in funding in 1999. It didn't mean every house deserved triple its value in 2006. The technology can be revolutionary and the valuations can be insane, both things can be true. So here's what happens next. Maybe it's 6 months. Maybe 2 years. But at some point, reality arrives. A recession hits. Interest rates shift. A major player collapses. Suddenly, companies need actual revenue. Assets need actual value. The music stops. And just like 1720, 1929, 2000, 2008, millions of ordinary people will lose money they couldn't afford to lose. While insiders, who saw it coming, will have already cashed out. The pattern never changes. The only question is, which side will you be on?